So hello class, this is a work through of the answer, at least one way that you could set up and calculate the answer to exercise number 1, practice for deferred taxes. We're going to make this our first year of operations, so we don't have anything prior to this in deferred taxes or any other account for that matter on the balance sheet. So after a year, our income is $223,000 on the income statement. That's income before taxes. So we take that, we stop there, we don't know what tax expense is until we do the tax return. So we go to the tax return, we find that there's one permanent difference, $20,000 of municipal interest. That gets subtracted out because it's not taxable. There are also two differences that are temporary. One is bad debts and the other is depreciation. Now, bad debts is the difference between the allowance, how much we estimate our bad debts are, and what we can actually write off for tax purposes. And the difference is always in the allowance for bad debts account. That's what's nice about bad debts, is we are tracking the difference all along, because the allowance goes up with an estimate and it goes down with write-offs. So the difference is $8,500. Remember, that's what you put on the tax return column, if you will, to adjust, to make it in line with the income statement. So we take the bad debts, and then we also take, we add that because the bad debt estimate is higher than the actual write-offs. So we're going to add that. That's going to make our income go up, taxable income go up now, and then in the future it's going to be lower when we write off those accounts. So that's a deferred tax asset scenario. The depreciation is almost always a deferred tax liability. In this case, it's true. We have an asset we bought for $61,500. The actual depreciation using straight line included in the income is $43.93. I just put that here for information purposes. That's what was included as part of the income statement to get our income before taxes. The depreciation on the tax return is be $61,500. We're going to depreciate it 100% in 1 year, and so the difference is $57,107. That's the difference between what's on the tax return and what's on the income statement. So our taxable income, when we're done with the tax return, will show $154,393. So we take that taxable income and we calculate the tax expense on that by using the tax rate, 21%. That's going to give us a debit to tax expense and a credit to taxes payable for $32,423. Then we go back and look at each of our temporary differences. Now, not the permanent difference, the temporary differences, to see what the change was in the liability. So first of all, we look at this one, and that we said was a deferred tax asset, a future taxable amount, deductible amount, I should say. And so we multiply that difference by 8,500 times 21%. We know that there's nothing from the prior year, so we don't have to compare it to last year or anything like that. And that debit to the deferred tax asset, meaning the deferred tax asset's going up, means our deferred tax expense is going to go down. So that's a credit. Then we look at this $57,107. We know it's a deferred tax liability. Again, we know there's nothing from the year before, so we can go ahead with a journal entry by taking the $57,107 multiplied by the tax rate. It goes up, the liability, the tax expense is also increased. So our tax expense is the 32 minus the 17,885 plus the 1193. So that's our deferred tax expense, or tax expense on the income statement. Now technically, the part that's taxes payable is current, and the other two together are deferred to add up to the 42,630. And remember, deferred tax assets and liabilities are long-term on the balance sheet. You net them together and you put it long-term on the balance sheet. Then we do the effective rate of tax, which is the tax expense divided by the income before taxes. That gets 19%. We know that the statutory or the law requires a 21%. So there's a difference of 2% from that. That's what we mean by reconcile. And why is that different? Because of the $20,000 permanent difference. All right. So if we had paid taxes, if we pay taxes at a 19% rate, that's 42,630. If we had done it at a 21% rate, it would be 46,830, and the difference is the 21% of 20,000 or 4,200. So that's how we would do the first year of this scenario.